And so as US yields rise, in a world where to operate on the global stage, you have to have dollars or you need US treasuries as collateral in order to provide liquidity and use liquidity and conduct commerce on the global stage. Even though yields are higher, people will still buy them. Institutions will still need to have them. And so that is where the liquidity will go. And when the liquidity goes to US government bonds that are now yielding higher rates, it deprives that needed liquidity from other entities that would normally get them, specifically overseas, either corporates or sovereigns. That in itself then drives a crisis, right? Because a lack of liquidity causes a crisis. And so I think those sovereign bonds will start to get rejected. And so it's not that everybody will want to buy treasuries, and it's not that everybody will buy treasuries, but it means that the US Treasury will, quote unquote, go bankrupt last.
I declare bankruptcy! Hey
everyone, and welcome back to Milkshakes Markets Madness. My name is John Kutsmeda. This is Brent Johnson. We talk about the financial markets, the madness of the world around us and in financial markets, and the milkshakes part of our name is related to the dollar milkshake theory, which talks a little bit about all of that, but is something that Brent came up with to describe the dollar's role in the global financial system, which you can learn more about following the Start Here playlist on the top of our YouTube channel. Now, Brent, let's look at what some of the things that have been going on. You know, what's fun for you usually is the banter that you have on Twitter. And might I add, the Milkshakes Pod Twitter account has been dropping some bangers this week. So if you haven't had a good laugh, head on over there. But you do have fun with this tug of war with people about generally, I think, just the emotional side of markets. FOMO is an easy thing for people to think about when we say, you know, being irrational and the emotion that comes with markets. But sometimes it's just this like falling in love mentality with whatever your favorite thing is, or once a trend starts to go your favor for a little bit. And this week, I think kind of just took the air out of everybody, because now we're back to this, you know, classic thing that we've talked about almost since the beginning. We've been doing this, and we're well into 111 episodes now. The violently sideways concept. And here we are again. Markets have basically gone square back to where they've been, more or less, at least so far this year, but in some cases the last 2 years.
Yeah, you know, I was looking at a chart, and I'm looking at it as we're talking right here. The Dow or the S&P as an example is almost exactly where it was at the end of 2021. Right. So that's over 2 years ago. But now we had a huge drawdown, a huge run up, another drawdown, a huge run up above that level. Now it's pulled back down almost to that level again. You know, so I think year to date now, you know, the S&P is up like 4%. At one point it was up 10, 11. The NASDAQ is now up 1% for the year. The Dow's up, I think, less than 1% for the year. The Russell 2000, which is, you know, smaller companies, that's down 4% for the year. But this is, you know, all of these are after being up substantially in the first quarter. So, you know, to your point, we've talked about markets have gone violently sideways for a number of years. It doesn't mean there hasn't been a chance to make money along the way. But, you know, just when you think the bulls are fully in control, you get a correction. And just when you think the bears are in control, the market turns and makes another rally. And, you know, I think markets are going to continue to be volatile in both directions, probably through the election and maybe even in the next year.
Well, you are known as the dollar milkshake guy, therefore you get pinned as the jingoist, the dollar apologist. So one of the things, though, that's not true about either one of those statements is you're often on record coming out and saying when the dollar rally has gotten a little long in the tooth. Does it feel like that here? There seems to suddenly be a lot of people patting the dollar milkshake theory on its back, giving you credit for what the dollar has done in terms of other fiat currencies. Is it time for it to pull back? And is this dip in equity markets and risk assets one that you potentially buy on the premise that it's basically been driven by dollar strength? So therefore, if the dollar corrects, stocks might rally again?
Well, I think in short, I am still of the opinion that we're going to have a buy the dip moment in equities this year. You know, we've talked about this for a long time. Um, I don't think we're there yet. Although, markets have come down a lot just in a week. I mean, markets, when I say markets, I'm just going to talk equity markets for a second. Equity markets largely fell between 4 and 7% in the last, call it, week to 10 days. They've crashed through their 50-day moving averages and through their 100-day moving averages. I think they're still 5 or 6% above their 200-day moving averages. If we get down to the 200-day moving average, that might be, again, this is ahead of time. I have to wait and see what's going on if and when that happens. But maybe that would be the place, where you buy it, where you start to get a little bit more constructive on buying the dip. Again, and I'm not saying that you buy the dip because things are good. I kind of think that you buy the dip because things are bad. And I've said that's been part of the milkshake theory since the very beginning, was buy U.S. equities, not because things are good, but because things are bad and they're going to get worse. The reason that's kind of counterintuitive is because the other part of the milkshake theory, and again, this goes back to the very first. The reason I'm going to say this is because I get called on this all the time, and all you have to do is go back to the very first time I ever mentioned this. Was that part of the milkshake theory is that the 40-year bond bull market would come to an end, and as yields went higher and people around the world stopped wanting to buy government securities or bonds, and money left fixed income, where would it go? I think a lot of it goes into, some of it goes into gold, obviously. And that's why I've always said gold and dollar rally together. But a lot of it, I think, will end up in the U.S. equity market. And so when you think about a sovereign debt crisis or a sovereign bond market collapse, that's not a good thing. But if money is rushing out of that asset class, I think one of the places it will ultimately go to is into large U.S. equities. And so it's almost like they become the new treasuries. Now, it doesn't mean that that's an easy buy and they're going to go straight up from here. I'm just saying, I think in general, over the years ahead, that's what's going to happen. And so that's why I'm looking for buying opportunities in equities. I'm not of the opinion that we're going to have one of these 4-year Great Depression bear markets. I can't rule it out, and perhaps that happens, but that's low on my probability list. But it doesn't, I think you have to have a plan to potentially buy them. Doesn't mean you have to do it. I think you have to have a plan to do it so that you understand why you would do it and what types of things you would buy. And I think we might get that option here in the next, 4 to 6 weeks. Maybe might be in the next 4 to 6 days. We'll have to wait and see.
Well, one of the things that you do push back against is this idea that the central banks, or at least the Fed, is out of bullets. And so if there was a crisis, the likelihood that they would be able to, that's one of the things perhaps why you're saying a 4-year nasty depression is unlikely, is because we've seen the central banks respond. We know that they're going to come to the rescue again. I think there's a lot of faith that that's going to happen. And generally markets are just driven on that psychology. So if we know the Fed's going to come in, it's not going to take them much before everyone gets excited, euphoric, and FOMO's back into some of these asset classes, one of them being, the equity markets. But the idea also at the same time that there's going to be this default or, a complete neglect of buyers for government bonds, at least US government bonds. Are we seeing an early sign of that? I mean, one of the things that's really interesting is right now, the 3-month T-bill is outperforming the NASDAQ. Do you see, this getting paid to wait is obviously working out very, very well. Does it just become a duration thing? Do people still buy government bonds as long as it's under, a 1-year term? Is that where you see the invisible default, so to speak?
Well, I do think people still continue to buy the short end of the curve. I don't know if they will buy the long end of the curve like they have historically. And if they do buy the long end of the curve, I think they will want to get paid more to do so. Now, this is the other part of the theory that I often get the pushback on. So again, part of the theory is that the 40-year bond bull market comes to an end, yields rise. When U.S. yields, and not just U.S. yields, all over the world, right? And so as U.S. yields rise, in a world where to operate on the global stage, you have to have dollars, or you need U.S. treasuries as collateral in order to provide liquidity and use liquidity and conduct commerce on the global stage. Even though yields are higher, people will still buy them. Institutions will still need to have them. And so that is where the liquidity will go. And when the liquidity goes to US government bonds that are now yielding higher rates, it deprives that needed liquidity from other entities that would normally get them, specifically overseas, either corporates or sovereigns. That in itself then drives a crisis, right? Because a lack of liquidity causes a crisis. And so I think those sovereign bonds will start to get rejected. And so it's not that everybody will want to buy treasuries, and it's not that everybody will buy treasuries, but it means that the US Treasury will, quote unquote, go bankrupt last. Now, I hesitate to even use that word because they're not going to go bankrupt in a currency that they can print, right? So then that harkens to the, well, doesn't the dollar lose value against real things? Probably. That's this whole, this whole rejection of fiat, and the dollar loses value, but all the other currencies lose even more value, and that's how you get the dollar and gold rising together versus all the other currencies. And so I think we are seeing the foreshadowing of this. Now, I don't think it's going to happen in a straight line. I say this all the time: markets don't move in a straight line. And I don't think this is all going to play out in the next year. I think this is going to take 4, 5, 6, 7 years to fully play out. There may be a couple little mini cycles in there, right? It doesn't mean it's just going to be smooth sailing in one direction for any of these different asset classes. But I think largely in the years ahead, you are going to see similar price action to what you've seen over the last couple of years. But I'm more worried about defaults and crises outside the United States than I am inside the United States. And people will often tell me, well, the fact that the US has got itself in this horrible fiscal situation is obviated by the fact that yields are now rising. Okay, fair, that's fine. But the point is that you are not going to have a situation where the US cannot get financing, but a corporate in Brazil can, or a corporate in the Philippines can, or the government of Turkey can, or China can, or Japan can. If the US cannot get financing, then nobody can get financing. And then that will be the end of the system, and they'll reset it and everything will start over. Right? And that is ultimately the thesis. And so yields going higher and problems in the US lead to even greater problems outside the United States. I don't like that this is the way it is. I don't think it's fair. I just think it is reality.
All right. So the Fed so far has gotten away with one of the fastest rate hiking cycles. It's now been paused for a while, so that's kind of in their history books. We're sitting at the 5% range. With that happening, we are seeing. We talked recently. Is this the early sign of that dollar milkshake event happening? But this is more really just getting the safest or the cleanest dirty shirt that's paying you the highest yield. You've said before, like, why would I take 4% in a tertiary market when I can get US dollar security, have the global reserve currency paying me 5% or more. So we're in that environment. So we're seeing capital find its way into the US, but that's a little different than there actually being this massive global loss of faith in the system and all of that money flowing into the US because of that. So is this really more just go where you can get paid in the meantime versus, the early cracks in the system?
Yeah, I think that's the right way to say it. Again, I think we're moving towards, and this is why people, whenever I get into these debates or these discussions, people want me to say that it's going to end in 6 days or 6 months or sometime in the next year. And it's not. It's going to take several years for this to play out, this, in my opinion. Now, do you have to be ready for it to play out next month? Sure, you have to be prepared. But I just don't think that's going to happen. And to your point, I don't think we're at this place where the whole system is breaking yet. But I think we're starting to see the early signs of it, right? And I think things are playing out the way I would expect them to play out if and when it does break. And that's why I think when we really do get into a crisis, and listen, it's possible this crisis never comes. Maybe they can just keep doing this for another 20 or 30 years. I think that's unlikely, but I can't rule it out. But my point is that I think if and when this crisis, the sovereign debt crisis, currency crisis, however you want to describe it, if it shows up, I think you are largely going to see what we've seen before play out on a bigger level. And it doesn't mean that the U.S. doesn't get hurt in this scenario. Again, I've used this example several times recently. John, you probably remember this when I can't remember how much older I am than you, but when I was about 13 years old was the Hagler versus Hearns boxing match. And it's one of the best, if not the best, boxing matches in history. And in the very first round, I think it was 1983, 1984. In the very first round, Thomas Hearns hit Marvin Hagler so hard that he had this huge cut on his eye, and they almost had to stop the fight because there was so much blood. But somehow they got the bleeding stopped. They went back to their corners, came out in the second round. And in the third round, he got hit again, and they had to come wipe all the blood off. And it looked like Hearns was going to win. And then, you know what? Hagler knocked him out in the third round. And so the point is, if the U.S. is Hagler here, I'm not saying the U.S. won't get hit. They probably will. They'll probably get hurt, probably going to bleed. A lot of people are going to think it's over. But the U.S. still has the ability to throw these knockout blows. And so I think the people, when they hear me say that the U.S. dollar is going to last longer than many expect, and that the U.S. equities are going to go higher than many expect, I sometimes think that they think that I'm cheerleading this, or that I think this is a good thing and that this is a good thing for the United States. That's not the good. This is the result of bad actions. These are the consequences of bad fiscal policy, and these are the chickens coming home to roost. It's not going to end well. I just don't think it's going to end in the time frame and in the way that many people think it's going to. It will ultimately be very bad for the U.S., but I think it will be worse elsewhere first.
We have some people that almost race each other to be the first to comment that this video is going to say it could go up or it could go down. So we're playing right into that meme. I'm sure there's going to be all kinds of people making that comment without even watching the video. So at least we got to reinforce the meme a little bit.
There you go.
One of the things that's happening, I think, more frequently as we've been doing the show is, at least it's more something that I'm observing, because we're always making sure that we're covering certain topics. And so we're focused on every topic that's happened in the week. And sometimes you have to look back at the week and you're surprised that, wait, that happened this week? Things move so quickly. And in the context of what you're just talking about, how, all these things are happening, they're going to get worse elsewhere first, or even if it's a negative impact to the US, you got to keep in mind that, we're probably going to be the last one standing in the ring. But what's interesting this week, we go into the weekend, we have, Iran retaliates to Israel. And then there's all this nervous anxiety. Is this going to be the beginning of World War III? It's really just turns into, two countries throwing sticks at each other. At least it felt like that geopolitically. Nothing really came of it, but it didn't even take, that was a Saturday evening, Sunday morning. By the time Monday, the markets open on Monday, it was like it never even happened. At the same time, you have the dollar slowly gaining on most currencies. The DXY is not the only thing to look at, while you also have the Japanese yen really starting to creep up into levels that, people are concerned about. Meanwhile, it feels like we have a little bit of a pullback on what was just a rip-roaring FOMO rally in any type of risk. When you put all that into a sandwich, how are you interpreting it? Are markets just looking for the next thing to jump to? You talk about liquidity. There's $6 trillion parked in money market funds. Is the response from 2020 and all that liquidity injected in the market just not going anywhere? And therefore, it's really just like tipping a bathtub. Like, where's the water going to rush to next, regardless of what type of chaos is going on around the world?
Well, I think the money in money market funds, again, it's reflective that for a long time, again, this is what I find so funny when you look at comments on central banks. For 15 years, 13, 14, 15 years, the commentary on central banks where the interest rates are so low, you're killing the saver. You have to go out 10 years on a high yield bond to get any kind of yield at all. And people were saying this is not capitalism. Money should not be free. You're distorting the entire market. Well, now you can get 5% to sit in a T-bill. The complete opposite. And people still hate the Fed, right? They still hate the central bank. They're still not happy. Now they're mad because, they jacked rates up so high, or some, and some people think that they need to jack them up even more. But no matter what they do, the central bank is wrong. And again, I'm not a central bank fan, but I do find that that's kind of funny. But the fact is you can now park money in T-bills and get 4 or 5%. That's not horrible, right? And the other thing is that, and I'm going to kind of conflate two different issues here, or bring two different issues to here, but this is probably a good time to do it, is that just because there's all this money in T-bills doesn't mean everybody's portfolio is all in T-bills, right? There's still, even though we've had this equity correction, there's still an enormous amount of money in equities. Even though the bonds have sold off a lot over the last 2 years, there's still a lot of money in fixed income, right? Gold is a pretty small market and it's gone up a lot in the last year. But I would say that's a small market. There could be a lot more money flow into that. But the point is the whole world is not just sitting in dollars in short-term T-bills. It's to me, it signifies that there's been a lot of liquidity created over the last several years. And now a portion of people's portfolios are happy to sit in a T-bill yielding 4 or 5% while they wait for the next great opportunity, right? And to be honest, that's kind of what I'm doing with our portfolios too. Now, I said I was going to relate this to another issue. The other issue is that, I think a lot of people, and I probably not on this channel as the regular viewers, but a lot of people I interact with think that the dollar milkshake theory says to just go sit in T-bills or sit in dollars. And that is absolutely not what it says. And I think part of the reason that I think people think that is we have become this culture of being all in on one thing. And people have become tribal on their portfolios. And then not only are they tribal on their portfolios, they think they have one thing in their portfolio, or one thing that dominates their portfolio. And they are so certain that they are right and that they have it all figured out that everybody else should be doing exactly what they're doing. Now, but I have never said that. I have never said anybody should sit in dollars and just wait for the next great opportunity. I think a portion of their portfolio should be in kind of short-term T-bills or short-term bonds. But I think a portion of their portfolio should be in gold. And I've always said that. I think a portion of their portfolio should be in real estate. And I've always said that. I think a portion of their portfolio should be in US equities. And I've always said that. So I am actually one of the people who still preaches diversification. It seems like the famous thing now to say, especially when gold has done well recently and when Bitcoin has done well recently and when NVIDIA has done well recently, is they'll pull out this famous line from Druckenmiller, which says that, I was always a pig and I would concentrate my bets in one basket and then I would watch that basket very closely. And I understand why he says that, because he's Druckenmiller. He can do that. But 99.9% of you out there are not Druckenmiller, and that is horrible advice. So if you're young and you're trying to get rich, then that's exactly what you should do. But if you have made money and you are now managing a portfolio and you're trying to keep it, you're trying to preserve its purchasing power, and you're trying to preserve the capital in there, the way you get rich is to concentrate. The way you get poor is to stay concentrated. And so, the people who think you should have all your money in gold, I can hardly deal with those people. The people who think they should have all their money in Bitcoin, I definitely cannot deal with those people. The people who think they should have all their money under the mattress in dollars, I think those people are idiots. I don't think you should be all in on any one thing. I think you should be prepared for everything. And we've talked about this before, John, is I think if people just tried to be prepared for everything rather than trying to be right about everything, I think their portfolios would do a lot better. And so I think the money sitting in T-bills now, to a certain extent, is people waiting for the next opportunity. And maybe we'll get that in the next couple of weeks or couple of months with equities.
What's interesting about everything you just said. Well, one thing I'll add is in that pursuit of creating wealth, becoming rich, typically it's not an investment strategy. It's more of a wealth building strategy when you can take big risks. And it's usually not in the market. You're usually building something. you're going all in on an idea. You're in control of bringing that vision to fruition. You're not just gambling that somebody else can do that for you, which is what investing in these equity markets are. Like, you have no control over what that CEO, what that board does. So you're taking a bet no matter what in the beginning to build that wealth. Take a bet on yourself. If there's something you're knowledgeable and you think you have an edge and you're passionate about, focus on that versus giving all your money to Tesla and thinking it's going to go through the roof because it's just your current religion. And I think Bitcoin is one of those, gold is one of those. And we are very sympathetic to the philosophy behind why people want to own those things. It's a big part of why we do this show. But keep in mind that, like you often say, and I've already said on this episode, that it's not going to just be a straight line up. And speaking of, we had this week the latest Bitcoin halving. So the mining rewards for anyone who's mining Bitcoin is cut in half. You would think that would, that reduction in potential supply or distribution of supply would, shoot the price up. Nothing has really happened. Is it because markets are always, playing on expectations and priced in the ETF and priced in this halving? Maybe it's just a delayed thing. People are going to start pulling out charts and trying to fit charts around their narrative and show why, the spike up always comes slightly after the halving. We'll see that. Maybe we won't. But going back to something like a gold, what's interesting here too for me is I've seen a lot of conversations around the fact that so few individual or retail investors own gold, and just you wait. Once they come flooding into the gold market, this is going to $5,000. And to me, it's the same speculation. Well, they haven't before. Why are they going to do it now? Especially when you're getting, paid to wait. So are we kind of getting into that situation where gold's run its course and now it's fighting against real rates? And the fact that you can have gold as an insurance policy, but if it's not paying you and you can put your money in something that is paying you with a real return, that becomes more attractive. And one other thing I want to add on top of that to get your thoughts on, do you have any, what is your view on some of the conversations or arguments being made about countries like China accumulating all this gold as a 3D chess move to eventually, de-dollarize the world?
So I think there's a couple things going on here. I think I think your point is very good, especially if people are all in on gold or all in on Bitcoin. Again, I have no problem with people owning Bitcoin. I have no problem with people owning gold. My clients own gold, and I think everybody should own gold. And I've always said that they should own gold. My clients typically own anywhere from 10 to 25%, which and I think that's enough. Now, if you want to go all in, that is fine. But I'll make another point, and then I'll get to your question of what I think is going on with gold now and what I think China's doing. But it's funny that I just happened to look at this yesterday. So in March of 2020, I was, let's say, having a friendly debate. Maybe that's the polite way to say it, with a well-known gold guy on Twitter. And he was arguing to me that older investors and even people in retirement should have 80% of their money in gold. And I said, that's fine that you think that, but I don't think that. And I think that, 20% would be appropriate for an overall portfolio. And he asked me to lay out what my portfolio would be. And he said he would have 80% gold. And I don't know, maybe it was 20% T-bills or something. So I said my portfolio, and this is a very general rule, and I'm not saying everybody should go out and do this, but at the time I said I would have, I think, 20% in gold, 20% in real estate, 10% in short-term bonds, I think 30% in equities, and then I think 10% in like a volatility / speculative overlay type thing. So I went back and did the numbers yesterday. And over that time period, that portfolio that I recommended returned 43% or 44%.
Is that annualized or is that?
No, that's total. No, that's
return.
total. That's the total return over that time period.
What was the time period again?
Since March of 2020. So almost 4 years. Not quite, maybe 4 years and a month or something like that.
Okay.
Right? Over that same time period, gold returned 44%. The exact same return, like within a percent. Amazing. But gold trailed for 3 years and 9 months. All of that gain has come this year. So it caught up with gold, or it caught up with the overall portfolio this year. And so this is my point with gold. Like, I think everybody should own gold. And in the long term, gold might not do anything for years. And then when it really matters, it'll go up a lot. And that's why I kind of own it as insurance. But if you would have bought gold in the summer of 2020, when it was around, I don't know, $1,800, $1,900, whatever it was, you wouldn't have made any money for 4 years. And if you were a retiree and you didn't have any other source of income, and you were 80% into gold, and maybe you had some gold miners, some silver or whatever it was, and along the way you had to liquidate part of your portfolio to pay your rent or drive your car or whatever it was, right? You are now selling at a lower price than you bought. Now, people are going to say, Brent, yeah, but you're cherry picking times. I'm using the time period of which this guy and I had this conversation, the exact same time. The point is over long periods of time, I think gold does very, very well. And I think it should be part of everybody's portfolio. But it doesn't mean it's going to pay off every year. And it doesn't mean it's going to pay off right away. And it doesn't mean it's going to go straight up all the time. And if you're all in on one, and listen, this could be said for equities, it can be said for Bitcoin, it can be said for gold, it can be said for real estate. If you're all in on one thing, and for whatever reason, you go into a downturn, even if it's unwarranted, even if it shouldn't happen, even if it's because of manipulation or government involvement, you become a distressed seller. And the last thing you want to be is a distressed seller. You always want to be in a position to be a distressed buyer. And so this is part of the reason I don't think people, especially people in retirement or near retirement or living on some kind of their portfolio is their only form of income, I don't think they should be all in on any one thing. Okay, so now that rant over. So now let's move on to what's going on. What I think is going on with gold. Part of the reason that I think what's going on.
Yeah, before you do that, I want to jump in. I don't want to kill your train of thought, but did you look at the CAGR, like how it compounded? Because that's 40% in just terms of the total return. But when you're thinking about the versus the slow climb up versus just this elevator ride up after 2.5 years of either ups and downs or no production at all. Did you see some better results, or was the NAV at the end
listen,
better?
The diversified portfolio was much more steady, much more consistent, a lot less volatility. But I just looked at the final return. What? I'll do a deeper analysis. Maybe I'll post it online, but it'll be a good exercise for me as well. But the point is that if you're diversified, you're kind of prepared for everything. You're not missing out on anything. If equities go up a lot, you're going to participate. But if equities crash, you're not all in on that either. The same thing for gold, same thing for Bitcoin. And, I know there's a lot of people out there say that Bitcoin is the greatest investment in the history of the world. How can you say that? That is true. But if you bought, at 50,000 a couple of years ago, and then it went to 20, and now it's back at 65, there was a few months in there where if you didn't have any other form of liquidity, where you were in a tough spot, right? And again, you were then in a situation where you could be a distressed seller than a distressed buyer. If that was your entire portfolio and you didn't have another source of income. Now, if you have another source of income or you have another source of liquidity, then maybe that's a little different. But, I used to talk to, and I still talk to, older investors, people who are either moving towards retirement or they're in retirement, and they're talking about living on their portfolio, and they're no longer going to have a regular check coming in. So I think it's important to kind of understand what your objectives are and what the purpose of your portfolio is before you can just blanketly say everybody should be all in on Bitcoin or gold or equities or Nvidia or whatever the security is. So let's go back to gold in China.
I'm sorry, Brent.
You want to interrupt me again?
Yeah, I do.
Okay.
I do. I want to.
Okay.
Not because I don't want to hear your thoughts on China. Everybody loves that.
We're skipping it. We'll do that next week now.
Well, one of the things too that's in line specifically talking about say something like a Bitcoin, where one of the things that I'm taking notice of when it comes to the how do I say this, the celebrities in the Bitcoin world. If you owned an asset, let's say Bitcoin right now 60,000, and you thought it was going to 600,000, why would you tell anybody that they should be buying this thing? Like if your level of confidence, you knew because of all the fundamentals, like, yeah, I get it. You would talk about it, but would you be climbing to the top of a mountain, screaming it? Would you be scolding anyone who doesn't believe in it? That's always kind of been the red flag for me in that, look, I own some for various reasons that we talk about here. But one of the things that just leaves me not feeling great about it is the way that those who've been in it from the beginning just kind of talk people into it like it's snake oil. That's just something that's always kind of made me uneasy about it, is that if you had an inside edge, you felt like you were early by a year, 2 years, even 20 years, like, human nature is greedy. Like, why would you tell anyone about it?
It just keeps playing out time and time again. Only the names change, right? It's human nature.
So go ahead, China. Sorry, I just wanted
Am
to
I
throw
allowed to talk about this
it.
now?
Yeah, go ahead.
No, okay. So again, I'm going to bring this back to the milkshake theory. And the reason I'm going to bring this back because this is my framework. This is what kind of frames all my different thinking. Now, at some point in the future, maybe I will change my framework. But right now, the framework is still holding, and the framework helps me think through things. And the framework is telling me that the part of the reason that gold is rising is for a number of different reasons. But a lot of it I spoke about in the very first interview, and that is as we get into a situation where the 40-year bond bull market breaks, and governments have to resort to either QE or stimulus, or they have to pay higher rates, and then they have to institute these new monetary policies in order to compensate for the increased budget deficits. This is going to put pressure on fiat currencies. And as the dollar rises versus other fiat currencies, it starts to break things in the monetary system. As things start to break in the monetary system, then people start to look for an alternative. And one of the things that has been an alternative, if not the central part of the monetary system for 5,000 years, is gold. And I said in the beginning that I thought we would get into a situation that as the dollar rises, even though the dollar's rising, and even though yields are going higher, which is normally bad for gold, you would start to see gold rise as a safe haven asset alongside dollar and alongside the yields, even though that typically doesn't happen. And I think that's what we're seeing now. And the reason that I think that that's what's happening is because most of the buying in gold is being driven by buyers outside the United States. It's not that people aren't buying gold in the United States, but they are buying gold much more outside the United States than they are buying it inside the United States. And the reason that they're buying it more outside the United States is their currency is falling a lot more than the dollar. Now, I know there's people out there saying, yeah, but the dollar is falling versus gold. You're absolutely right. You should all own gold. If you don't understand that when I say everybody should own gold means that you should own gold, I don't know what else to tell you, but you should all own gold. But you should especially own gold if your home currency is not the US dollar, because the governments around the world are struggling even more than the US. They're having inflationary pressures in their local currencies in things that matter more than the US. And as they are worried about the purchasing power of their own currencies, they are going out and buying gold. So I think you're kind of seeing a conflation of all of these things together. Now, I will tell you that I am very glad that I've owned gold for a long time, because I don't like buying anything at their all-time high. And right now, gold is at its all-time high. Now, if you don't own any gold, then yes, you should go buy some, even though it's at its all-time high. But if you've already owned gold for several years and you already had your full allocation, then you don't need to go chase it here. You don't need to go buy it. You already have your insurance policy. So anyway, that's what I think is going on around the world. I think part of the reason that these other countries are buying gold is they know that the system itself is not sustainable long term. And I think they buy gold. When I say they, I'm talking about the central banks, and whether it's China or Russia. A lot of central banks around the world are buying gold. I think they bought more gold last year than any year, since the late 90s or something. But I think central banks, monetary authorities, the reason they buy gold is twofold. One, they buy it as insurance for the same reason that you and I do. They know that in some kind of an extreme event, gold will still hold value. They can use it to kind of remonetize the system. They can use it to bring confidence back into the system. I think that's a big part of it. But I think another part of the reason they buy it is control. If they own it, then nobody else can own it. And if you hold on to something, you have control over it. I think we talked about this before. I think central banks hold on to gold for the same reason that, the United States is having Great Britain hold on to Julian Assange. They want to control him. When people are out there doing things you don't want them to do, you throw them in a hole and you lock the door, right? What do you do with gold? You throw it in a hole and you lock the door, right? And it's not just about having it for an insurance policy. To me, it's you're controlling it. And again, I think, part of the reason that governments don't audit their gold and they don't publish their gold is they don't want people to know how much they have. They don't want, this is a form of control. If they wanted if they didn't want any control over it, they would list all the bars and they would list the numbers and they would have open transparency on it, but they don't. They don't want there to be transparency on it because they want to control the narrative with it. So I think it's kind of again, there's this duality to gold, same as there's this duality of money that we've talked many times about, but there's this duality to gold that, the governments and the monetary authorities, they have to own it, but they also have to control it. And it's, ultimately, I think that they will lose that game, and I think gold will go much, much higher. But in the meantime, that's what's going on, I think.
All right. I just want to make sure that your son Moses is not currently in a hole with the door locked.
No, Moses is good. Moses.
Okay.
I sometimes I want to throw him in a hole and lock the door, but no, he's a good kid.
Well, he just had some exciting news, did he not?
He did, yeah. So, proud dad moment. So we moved to Puerto Rico 3 years ago. At the time, he had never picked up a volleyball. And about a year and a half ago, he's very tall. The volleyball coach in his high school kind of cornered him in the hallway and said, "Why aren't you on my volleyball team?" And shortly thereafter, he was on the volleyball team. And so he's gotten very good very quickly. And he just made the Puerto Rican 17 and under national team. So it's pretty exciting.
That is exciting. And although it's Puerto Rico, you would think like, well, who cares? It's Puerto Rico. One of the things that's really important to keep in mind is when you live on an island, there's very few things that you participate in. Beach volleyball is one of those. So it's definitely not an easy competition to make that team. So congrats.
Yeah. And he's he plays both beach volleyball and indoor. This is the indoor league, but it's a great sport. And the fun thing for us about it is, volleyball in Puerto Rico is a little bit like football in Texas. Like everybody plays it, everybody goes to it. It's a kind of a big thing. Everybody enjoys it. So it's been a fun part for us to be part of the community and, get to know a bunch of different families and parts of the island, through all these different volleyball tournaments.
Well, if they're ever open to wearing pink, maybe the Milkshakes pod can become a sponsor.
There you go. That's a good idea, actually. That's a good idea.
All right. Well, look, Brent, it was a good chat. For everyone who's stuck with us this far and has, enjoyed the channel for this amount of time, like I said, this is 111th episode. I know some of these threads that we continually just pull on, but they're good reminders. This was an interesting week in that it felt quiet, although there was a lot of things that have happened that were important to put highlights on. Hopefully, some of those things we discussed will add some value to the decisions that everyone has to make going forward as we try to find the new balance. Is this, the beginning of a deeper pullback, or is this just, an exhale before the next move higher? Brent, is there anything next week that you're looking at that might give investors a signal of which direction things might go?
I don't know if there's any Fed speakers next week, but I know there's a bunch of data. There's PPI coming out. There's GDP coming out. I think there's some PMI stuff coming out. So There's a bunch of data, and then the week after next is the Fed meeting. So it's not that far away where we'll get some more. I think there won't be any Fed speakers next week because I think they're in the blackout period. But I expect it to be a very volatile week. There was a lot of damage done in markets last week, and so I would expect there to be a little bit of follow through this week.
So you did have a hot take a couple episodes ago. I think you said Nvidia would go to 1,000 or $1 or something silly like that, right?
I think I said it would go to I think it was around 750 when I said it, and I think I said it could go to 1,000 or 500, and it might do both. So we got pretty close to 1,000. I think we went to 940, 950 or something like that, and now it's back to 770. So maybe we'll see 500 here pretty soon.
Okay, so what kind of hot take do you have on the Fed? Do you think this is another pause?
Unless we see massive dislocation next week, I think they'll pause in May, but then maybe we get something in June. Again, I don't. I think the reason that they would cut is just to say that they did it. They've telegraphed it so hard that I kind of think that they want, and I kind of think that they want to cut. And if they get some more market turbulence, it gives them the perfect cover to do it.
Do you think the market turbulence, if we want to call that what we just had this past week, if that continues, it's violently sideways, right? It's not massive drawdown turbulence. I know you've kind of made this reference that the Fed wants to cut because they've said so, but it feels like the stickiness of inflation is definitely more of a concern. Do you still feel like that they need to save face with a rate cut at this point?
I don't think they need to, but I think they want to, right? And so, to be clear, as of right now, we've had a hard pull down in equities, but the VIX is still under 20. Things haven't really broken; they've just come down really fast, really quickly. And if things break hard from here, then, but at this point, I don't think they have enough cover to cut, especially with there's been some sticky inflation prints. I guess I'm just saying if over the next month to 6 weeks we get a lot more volatility, we get the VIX in the high 20s or low 30s, and we get markets down another 5 or 10%, and then we get one soft inflation print, maybe that gives them the cover to cut once, just to say that they did it. Again, part of the reason, and I think they would prefer to cut in June or by June, because I don't think that they want to cut in July or September ahead of the election.
Sure.
But if they need to cut in July or September, I think they would. So we'll see.
I know you love a good conspiracy theory. Do you think there's any kind of forced suppression of vol?
That's a loaded question, man. I mean, I think at the end of the day, all markets are to a certain extent manipulated. That's the whole reason that central banks exist in the first place. So the idea that they are not out there in some form or another trying to suppress vol, I think that would be more naive than to say that they are, that they're not suppressing vol. But how and when they do it, I don't know. But I do know that when the global financial crisis happened, that was a big wake up call for everybody, especially the central banks, and they have spent the last 15 years, and especially then post COVID, they have put all kinds of plans in place and programs in place that I think they will be quicker to act than they have in the past. I don't necessarily think that's a good thing, but I do think they will be quicker to act if necessary. And again, at the end of, I'm going to go off on a little bit of a tangent here, but the primary function of any central bank, no matter what the textbook tells you, no matter what the speakers tell you, no matter what your professor at business school tells you, the primary function of a central bank is to keep the status quo going and to keep the government in place. That is the point of them. And if they can smooth out the business cycle along the way, fantastic. And so, with everything that happened in the global financial crisis and then everything that happened in COVID, I think they know that the system itself can be shaken and be shaken very hard. And I think that they have put many things in place to help them manage it. Now, I also think that it's ultimately going to get away from them. And when it gets away from them, I think that's when the dollar goes to 150. Now, again, to your point, what you said earlier in the show, I think they have a lot of bullets left. And that's partly why I don't think that this is going to end in the next 6 to 12 months. I think it's probably going to take another 4, 5, 6 years. But it will ultimately get away from them, and then we'll really have a show to talk about.
Do you think one of their bullets are to slowly, and while denying it, set their new benchmark, inflation benchmark at 4% instead of 2%?
Yeah, of course. They're never going to say it out loud, but I think they would love to have 3 to 4% inflation for the next 10 years. I think they would love that. If that eats away 30, 40% of the debt, right? They can't come out and say it, but I think they would love it.
Well, it erodes 30 to 40% of the current debt, but the way the government's spending, we'll see. Well, look, you guys who stuck around, you got some hot takes from Brent. You got a little bit of central bank conspiracy in there. We appreciate everybody. Follow us on Twitter and on YouTube at the handle Milkshakes Pod. Like I said, we're throwing in some fun ones on the Twitter feed this week. You can find Brent there at Santiago AU Fund. You can find me at John Kutsmeda. That'll do it for this week. We'll see everyone next week for another episode of Milkshakes Markets Madness. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.